Welcome back to the Fostering Financial Victories podcast. I'm Eric, your host. I am joined today by Rob Coleman, so wealth coach with Foster Victor Wealth Advisors. Rob, you joined me on a episode last year around this time when all the stimulus package stuff was coming out, so I'm glad you could kind of make your reappearance.
Yeah.
So a little bit of background on Rob, 32,
Yep.
right? So you and I started in the business pretty similar in time. I think you might have started a little bit before I did, right out of college.
Yep.
So from Greenville?
Yep.
Give me a little bit of background on how you got to where you are right now.
So born and raised in Greenville, went to Presbyterian College, did a internship with a financial company and went full-time with them and been in the industry ever since.
All right. So he's not going to tell you this, but Rob is the most designated individual on our staff. So he's got a lot of letters behind his name that nobody knows what they mean. But it's really cool. So very knowledgeable individual. So what we are going to talk through today are some of the stereotypes of the financial advising world. Mm-hmm. The biggest one that always comes up, and you and I were talking about this earlier this week, is, we hear it a lot. Hey, you've got to be really wealthy to go use a financial advisor. Where do you think that comes from? Why do you think people have that stigma about approaching a planning firm or maybe having that conversation?
I think, one, there's a lot of confusion because there's so many people in the industry, so many professionals in the industry, and they have similar titles and similar roles, and they all do something a little differently. And so people just don't really know, so they just associate it all with wealth management or investment management. I think there's a lot more to financial services and financial planning than just the investment management piece. That's obviously a really big piece of what we do, but I would say the majority of our clients probably get equally as amount of value or more value from the planning side and the strategies that we come up with. So, when we think about financial services and financial advisors and financial planners, they all kind of get put in the same category when they do different things. Some are more commission driven or product focused. Some are more just focused on the asset management side, and some are more focused on the planning side, and then some are a combination of all of that. And so I think the stereotype is you got to have $1 million or all this money to sit down with a financial advisor, where there's certain advisors that are going to be able to help you, not just with the investment management side, but also the planning side and a lot of other things that come with just financial planning in general.
So I think you hit on a few things. So there's a lot of confusion around what people actually do inside of their practices.
Yeah.
Most people, from what I could tell with that stereotype of, hey, you've got to have a lot of money to go and sit down with someone in a planning setting, it's probably coming from more of the investment world.
Yeah.
Is that would that be fair?
Absolutely.
And what I'm hearing you say is that that's just a piece of it.
Yeah.
So kind of talk through what the other elements would be. I know you hit on them just briefly, but what are the other elements that people would be able to get help with?
Yeah, I think some of it is, they think about the investment management side. They talk about asset allocation, but asset location is a really big piece as well too, is thinking, hey, you could be young in your career, and where are you from a tax bracket perspective now? Where will you be 10, 15 years from now? And where will you be in retirement, assuming tax bracket stayed the same? Is you could be very strategic with where do you put those dollars? What investment vehicles do you save those dollars into? And how does that fit into your overall plan? And a lot of people don't do that. They just save money in one way. They don't save it in multiple ways, and they don't always have the foresight from a plan standpoint of what's the most advantageous way for me, maybe not just right now, but also down the road.
So when is the ideal time for somebody to, is there a certain age? You're in your early 30s. I'm in a little bit older than you are. I'm not going to say how old, but a little bit. What you may be focused on could be totally different than what someone in their 40s could be focused on, as well as the 20s. Is there an ideal time?
Well, honestly, the most ideal time is now. Like, time is the best money-making asset anyone can possess, and young people have the most of it.
Hang on, say that one more time.
Time is the best money-making asset that anyone can possess, and the younger people have more than someone that's older. So,
okay.
time is on their side.
That's really good. You should write that down if you're listening. Okay, so if you're young, you got a lot of time. What can you do if you're just getting started? Like, what should you be thinking about? We hear a lot of, hey, I need to pay down debt, like whether it be student loans or whether it be car debt or whatever it is, and then they'll hit pause on doing anything else until they pay down debt. What are your thoughts there?
So I think it's dissecting the debt conversation into what type of debt is it? Not all debt is bad debt. You know, a 3%, 4% interest rate on a home, which is your primary residence and it's tax deductible, is way different than credit card debt at 17%. You know, you should pay down that consumer short-term credit card debt as fast as possible because that is really, really hurting you. But when it comes to debt that's longer term, that's tax deductible, you know, when we see these aggressive overpayments, you could probably be putting those dollars to work in a more advantageous way than paying something that feels like probably a tax-affected 2%. And so I think it's one, looking at what type of debt is it and what is that high interest rate debt, and definitely targeting that, paying that down as quick as possible. But the lower interest rate debt that could be tax deductible, is that really the best thing to put all your discretionary money towards? And so I think you got to just really tackle the debt, dissect that, and then figure out, well, you know, is that the best place to be putting that capital? So
society and folks who, you know, are out advocating to, you know, snowball debt programs, and I'm all for paying down, you know, leveraged positions, but like what you're saying is that maybe that's not the best use of a dollar given the whole time piece that you mentioned before.
Yeah. You know, we were talking before this, and I showed you a really good example of three different people. And the first person, let's call it Erik, because Erik over here is really smart. Erik saved from his age 25 to 35, $5,000 every year, and then stopped. And then let's just say Tim waited 10 years, and he saved from 35 to 65, $5,000 a year, and stopped. So Tim saved $150,000, 3 times more than Erik saved, which only saved for 10 years. Assuming a 7% interest rate, at age 65, Erik had more money than Tim, and he saved a third of it. And the reason was it was time. He saved earlier, and then those dollars compounded. And so a lot of people always say, I'm going to save later. I'm going to save later. Well, they have to work harder because they lost out on that time. And so it's really telling to say, hey, you don't have to have $1 million. Save a little bit. Save what you can early on and have those dollars work for you. You know, when someone doesn't hit a retirement goal, or they do retirement projections and they realize, hey, I'm not on track, you have 3 options. You can save more now, you can retire later, or you could spend less in retirement. Most of our clients will decide, hey, I'm going to try to save more now because that's just going to give me more options. Maybe I can retire earlier now. Maybe I can spend more in retirement. Maybe I can give more of my wealth away to kids and grandkids because I chose to save more earlier.
If you have someone who is just starting out of college and they're, you know, starting their job.
Yeah.
Right. So kind of thinking about what do they have access to do? Well, one, they have a brand new income. They're trying to figure that out. What do they do first? Mm-hmm. And then let's go to the opposite end with someone who is 45 and all of a sudden the light bulb has come on. It's like, oh no, this is now, you know, call it 15, 20 years from now when I want to retire, I got to figure this out.
Yeah.
What are the 2 approaches that they may take?
Well, so I think the younger person, you know, they always think, well, I'll be able to save more when I have more money. And, you know, that makes sense. But life always happens. And the 45-year-old that just had the light bulb go off realized there's always going to be something that comes up. There's always going to be something that delays you to save at the level that you want to save. So the best thing is to develop habits early. And hey, if you're older now and the light bulb's coming on, you know, you just got to build that discipline and you got to start putting dollars away. It's easier to build on something you start than to start fresh.
So if you're starting on that lower age bracket, mm-hmm. what I'm hearing you say in roundabout terms is that it really doesn't matter the amount.
No.
Just start.
Yeah.
Right?
Because let's say you started at $100 a month. You're going to forget about it. I've actually had people forget that they set up a big contribution to a 401k or savings automatic draft into an investment account. And then we get back together and they're like, man, I didn't even realize I had all this money, because it just gets built into the budget. It's kind of like, just different bills and payments. If you set up these bills, which is really a contribution into some type of savings vehicle, it gets lost in the monthly budget. And then when you see how much money you've saved over that period of time, can you increase it a little bit? Yeah. And then you just keep doing that, and you've built the discipline of paying yourself first. And I think that's the best way. And so these people that are younger, starting out in their careers, you do not want to get into the delay tactic where you say, hey, I'll do more later. Well, you're not only going to have to save it later, you're going to have to save more later because of all the time that you missed out on when you could have been saving just a little bit starting out.
So two mindsets, right?
Yeah.
Save first, spend what's left.
Yes.
Or spend first and save what's left.
Yeah.
One of those is probably a little bit more successful than the other.
Absolutely.
Right?
Yeah.
So what I'm hearing you say is, if you're starting out in your working career, identifying what your cash flow might look like, what your expenses are, but go ahead and build in as a part of your expenses an element of savings.
Yeah.
Just to pay, like you said, pay yourself first and create it to make it look like a bill.
Yeah. I would say our best clients, their biggest expense, what I'm calling an expense, is paying themselves first or saving those dollars. And when they have that discipline where their biggest line item on an annual basis is what they're putting away, when they're not receiving that income anymore, they've adjusted to a really good lifestyle, and they've put away a lot of money to where they're going to be able to maintain that lifestyle.
Okay. So we've talked about the younger person trying to get started, and whether that is building into a 401k type of an environment or an IRA or just cash. I mean, at this point, it doesn't seem like it makes a whole lot of difference where you put it. Just put it somewhere.
Yeah.
Right? Don't spend it.
Yeah.
So let's go to the other end of it. Let's say it's the 45 to 50-year-old who now this stuff is real. They see that retirement isn't what feels like 90 years away when you first start working. What do they do if they realize, hey, I'm really behind, or I feel like I'm behind?
Yeah.
How do they maybe approach that?
I think first is seeing, what is the score? Like, where do you line up? And a lot of people.
What do you mean? What is the score?
A lot of people don't know. They're saving money, and they're saving money because they know they have to, but they don't know how much do they need to be saving, and truly what are they working towards. And so let's say that 45-year-old, in a perfect world said, hey, they want to hang up the cleats at their age 60 or their age 65. Well, I think they should look at, what are they spending now, and what do they think they are going to be spending in retirement? And so what will they need to start retirement to be able to maintain that standard of living? So a lot of people don't know the score. So a lot of people say, hey, I'm saving money, I'm doing my 401k, I have a match, I have this, I have that, but they don't know what it's going to amount to. And so I think it's really projecting out, well, what do you need to maintain that standard of living? What do you have to save now in order to spend at a certain level in retirement? And so a lot of people won't know what that number is. And so they're saving because they know they need to save, but they don't know what they need to save.
What do you think somebody could safely project as what they might spend in, call it 25 years down the road? How is that? How do they approach that?
Well, I think the easiest way to do that is inflation is definitely a key piece that you want to factor in there, but what are they spending now? What is their monthly budget, and what is it going towards? Because there's going to be expenses that go away when you get into retirement, but there's also going to be expenses that you pick up, and there's going to be a lot of expenses that carry forward into retirement. So I think it's really analyzing, well, what does cash flow look like, and what does the outflow look like right now? What am I going to carry forward into retirement? What am I going to pick up? And maybe what expenses are going to go away? A lot of people think all these expenses are going to go away when they go to retirement. That's just not the case. When all of a sudden these grandkids come into play, all of a sudden you see them somewhat or sometimes spending a little bit more money those first few years of retirement because they're not working 9 to 5 like they were, and every day is Saturday. And so to occupy their time, they're spending a little bit more money than they were spending. Not significant, but I think it's worth looking at and figuring out, what am I spending now? Is that probably what I'm going to spend? And then we can factor in the inflation later, or with that analysis.
That's great. Yeah, I think it still kind of comes back to your initial statement about time, right? So if you're in a feeling right now to where maybe you haven't taken a lot of action on saving, at least for what you think you might need to save, what I'm hearing you say is the first thing is to find out where the baseline is.
Yeah.
What's the score?
Yep.
What do you need it to be? Okay. So there's a lot of ways people can do that outside of, hiring a firm to help you.
Yeah.
Obviously there's a lot of, retirement calculators out there that people will have access to. You can get on your Google machine and find a dozen of them right now.
Yeah.
I think just taking a little bit of time and talking through it is probably going to be pretty beneficial just to see what the score is.
Absolutely. And it goes back to a point I made earlier, is if you see what the score is and what are you saving now, and are you falling short? And if you're falling short, you're going to be posed with those 3 questions. Can I save more money now?
Yep.
Do I need to push back that retirement date, or do I need to look at spending less in retirement? The one that's going to set those clients up for the most success is saving more now, because then they could potentially retire earlier or spend more or give more in retirement. But knowing what that score is and mapping out a game plan to tackle it, I think is the most important thing. And the younger clients, one, they have time on their side, but the amount that they have to put away annually with 30 years of work ahead of them or 35 years of work ahead of them is way, way smaller than what the 45-year-old needs to put away that hasn't done any savings.
Any tips on how people could create some free savings during the course of the year that they may not be thinking about or may not just be aware of?
So some of our clients will realize, or sometimes they don't realize, towards the end of the year they're starting to receive more in their paycheck, and they don't know why.
They get a raise?
And they didn't get a raise. And
okay.
I want to turn the question back to you, because from the Social Security standpoint, once that they have hit that limit and they start receiving more, I think you might be one of the best people to answer that, of what you encourage your clients to do.
Yeah, so what we're talking about is the limit on earnings and contributions in Social Security.
Yep.
Right, so it's not going to affect everyone. It's going to affect folks who make over a certain amount of money per year. Essentially, at the base level of this, not to get too far in the weeds, but you stop having your contributions go into Social Security for every paycheck.
Yeah.
So when you look on your paycheck, you'll notice there are a lot of deductions that take place, some more than others depending on your benefit program. But at a certain level, and I think this year they've moved it up a little bit. What is it, like $130,000 somewhere in there? They adjust it every year. But once you make over that amount of money per year, you stop having Social Security being put into your bucket. Okay. What that ends up being, though, is now you have roughly a 6% jump in your take-home pay.
Yeah.
So one thing that we try to make people aware of is just to notice when and if that takes place during the course of the year, and to capture those dollars before they realize it of spending them. Because most people, like what you're describing, they see that jump in income and they don't know why.
Yeah.
And then in January,
they've had budget creep.
It magically goes back.
Yeah.
It vanishes, and then they're in the red.
Yeah.
So maybe that's a way that we can create some free savings if you're in that income limits. You just capture those dollars, save them, and then in January you just act like nothing changed. What else?
So we see that on the Social Security side, but we also see that they've maxed out contributions through payroll early, whether it's an HSA or a 401k.
Okay.
And so depending on what their limit was, sometimes they reach that max contribution, halfway, 3/4 of the year. to where not only do they max out Social Security, get that 6% raise, or not really a raise, but 6% more in their take home,
Yep.
plus they're receiving more in their take home because they've maxed out contributions. And so knowing, when that's going to happen, to where that they make sure they save those dollars, because if that happens in September and they have 3 months where they're now having more coming in, and there's this thing called budget creep, somehow they start spending that money, and then January is a rude awakening when those contributions start back up, the Social Security starts coming out, and their take-home pay is not what it was like the very end of the year.
What about when they get an increase of whether it's a cost of living adjustment for salaries or variable compensation that may not be predictable during the course of the year?
Mm-hmm.
That could be another way that people can create some free savings.
Yeah.
Just capture some of it.
Yeah.
Right? They weren't living off of it anyway.
Mm-hmm.
So unless they've already spent it in their mind, which some people,
Yeah.
Pretty good about doing that.
Yeah.
It's hard not to want to spend extra money that just shows up. But I think going back to your initial comment of just having time on your side and just being diligent.
Yeah.
Right. Anything else you have from like the compounding interest side of things? I know we talked a little bit about the study that we looked at earlier. I found it just very interesting that the third person in that.
Oh yeah, we didn't even get
talk
to
about that person.
The third person, the person that saved
consistently
from their age 25 to 65.
Yeah.
Comparing that to the person who saved from 35 to 65, that third person ends up with over double the amount of income, or double the amount of portfolio balance.
Yeah. And saved only another $50,000 during the course of their lifetime.
Yeah. It really does show the power of compounded interest. And a lot of people don't see that in those first few years of savings, because it's they're starting from scratch, and they might see, whatever the annual rate of return is, but it's on a smaller amount of money, so they don't see the magnitude of it. But if they just keep doing that and keep working that muscle, it really pays off in the end.
For a lot of folks who aren't keen on pulling out a financial calculator, one easy way to do this could be the Rule of 72.
Yeah.
So to give you a little bit of an insight as to what an account might look like. So this is that back of the napkin math, to where you literally take 72, divide it by the rate of return that you can expect on an account, and that's going to give you a rough estimate on how many years it'll take to double the account value.
Yeah.
So if you do that just on paper, it gets pretty interesting really fast.
Mm-hmm.
You start doubling account balances every 10 to 15 years, and before you turn around, it's significant.
Yeah. Cooking with hot grease.
Yeah, it gets moving.
Yeah.
Okay. Anything else you've got that you think might be helpful for folks to understand as far as kind of addressing the stereotypes? And really, I think at the end of the day, it's just don't be intimidated by it. Just go have a conversation with somebody if you want help.
Yeah.
Like, don't be assumptive that they don't want to work with you.
Yeah, I think it's, one, finding the right type of professional or advisor that can help you, depending on where you need help. The amount of money shouldn't dictate whether you seek out advice or not. You don't need $1 million. There's a lot of different areas, planning strategies that a lot of people can have, but just finding that right advisor and having that conversation.
Someone that fits your personality and what you're trying to accomplish.
Yep. Absolutely.
Okay. So planning takeaway from this, I think it's pretty clear. You can probably go back to the quote that Rob gave us about time. You really can't recreate it.
Yeah.
Right? So it's the biggest asset you could have, and the younger you are, the bigger it is. All right. So, Rob, I don't think I asked you these questions before, but since you're in the hot seat, you get the guest questions.
All right.
If you could buy anything in the world, regardless of what it cost, what would it be?
If I could buy anything in the world. So
anything.
Like, honestly, it's time. Like, everyone runs out of time. Everyone's to-do list doesn't, and that's not even when it just comes to the compounding side. It's time. Everyone wants more time. Someone might have missed the gym today. They weren't able to do something because they didn't have enough time. So time is definitely something that I would love more of.
That's a good answer. What about the last 2 things that you spent money on?
Last 2 things I spent money on. I guess it was lunch yesterday. And what was it before that? Unfortunately, I had to replace my HVAC unit in my house.
Oh, that's a big ticket item.
Yeah, it was. I'd been kicking the can down for about a long time, so that got installed yesterday.
So
as
one
well.
of those is completely unlike the other.
Oh yeah, that was very tough.
All right. Okay. Well, hopefully this was helpful for you guys that took this in. If you have questions or comments or suggestions on topics for us going forward, you can find us on our website at www.fostervictorwa.com. That's a lot of W's.
Yeah.
Or you can find us on Instagram at Foster Victor Wealth Advisors. Thanks for spending time with us, Rob. I really appreciate it.
Absolutely.
We'll see you next time.
Sounds good.
Information contained in this podcast was intended for general use, not to be used as specific advice. For content tailored to your personal situation, please contact one of our wealth coaches.